There's been a growing concern about the possibility of an upcoming recession, despite Wall Street continuing to reach all-time highs. Consumer confidence fell in September, and the Conference Board's expectations index fell further into recessionary territory last month. The yield curve inverted and then promptly righted itself, and concerns over tariffs and the government shutdown keep fueling speculation that a recession is coming soon. But of course, recessions are always coming, as they're a natural part of the market cycle. The problem that always exists is trying to figure out when exactly the next recession will start. And of course, if anyone actually could predict recessions, that would make them extraordinarily wealthy. But I was recently asked what my strategy would be when we do go into our next recession. What would I sell, what would I buy, and in what ways would I change how I handle my high-yield portfolio? As I like to preach on my channel, if you're a high-yield investor, then dividends should matter more than short-term share price movements. A good holding will recover in share price eventually, like what happened during COVID and Liberation Day. But what's always worse for income investors is a dividend cut, and unfortunately, they always happen whenever we do enter a recession. So considering all this fear going around right now, I'll go ahead and talk about what my strategy will be whenever we do experience a recession. Now, to start things off, in general, I like to keep my portfolio as recession-proof as I can. Although there are indicators we can look at, no one can predict when exactly a recession will start, and no recession looks exactly the same. It's why I don't try to capture certain opportunities that look good in the moment. To give an example, some single-stock yield-max ETFs can do very well for a length of time. But someone who lives off dividends and depends on dividends for their livelihood should try to ensure that most of their portfolio is as recession-proof as possible. To point out what I like to do, two of my largest covered call holdings are exposed to very large indexes. They're diversified and they aren't small indexes of 20 or 30 stocks. I also don't have any covered call funds that are exposed to just one single stock. The majority of my REITs and my largest REIT investments have gone decades without experiencing a dividend cut. Realty Income has never gone through a dividend cut since they were publicly listed back in 1994. Triple N REIT has gone over 36 years without a dividend cut, and just like Realty Income, they've grown their distributions every single year. My largest closed-end fund investments have gone over a decade without a dividend cut, and some of them have never experienced a cut. And on top of that, most of my CEFs have been around for a couple of decades. My business development companies all have the highest quality investment portfolios in the sector. As of October 28th, the average non-accrual rate in the BDC sector is 3.8% at fair value. All but one of my BDCs have non-accrual ratings that are much lower than average. Ares Capital is a mere 1% at fair value. Blue Owl Capital is sitting at 0.7%, and Blackstone Secured Lending Fund is at an incredible 0.3%. Non-accruals are the percentage of investments in their portfolios that aren't performing up to expectations, meaning that they aren't collecting interest on their debt investments. So overall, I do feel good about my holdings. Now, I cannot guarantee that none of my investments won't go through a dividend cut. And I'll even say that in the event of a recession or a major market turndown, you should expect to see a couple of dividend cuts in your own portfolio. That's why high-yield investors should be well diversified, even potentially more diversified than average. Despite feeling good about my portfolio, there would be some things that I would do if we do enter a recession, which I'll talk about. In terms of unloading any positions or even entire sectors, I would likely sell out of at least one of my two remaining mortgage REITs. This used to be a sector that I was a much bigger fan of many years ago, and the mREIT Annaly Capital was actually my first ever high-yielding stock purchase. But as time has gone on, and I've talked about, and I'm sure people have noticed, I really don't like this sector anymore because these companies just cannot stop cratering. If you go back and look at mortgage REITs during the 90s and the early 2000s, then times were a lot better for them back then. But today there's only 3 mREITs that I'd consider myself a fan of, which are Rhythm Capital, Arbor Realty Trust, and Starwood Property Trust. Every other mortgage REIT has gone through dividend cuts, NAV erosion, and falling income over time. And this usually accelerates when times are bad. The mortgage REIT that would be on my chopping block is Arbor Realty. They do extremely well when the economy is going great. They have a winning strategy that's provided more dividend increases than any other company in this sector. On their latest earnings call, their CEO even outlined a plan they had to start regrowing their dividend in 2026, again assuming there's no recession. But whenever there is a recession or a major market turndown, then this company really struggles significantly. Rhythm Capital is really in a league of their own. After transforming themselves in 2020 during the COVID pandemic, their dividend has always been extremely well covered, but we'll have to wait and see how they do if a recession occurs. With my business development companies, it's really going to depend on which companies hold up the best. If I see one or more BDC's credit qualities collapsing, or a company that's really struggling to cover their dividend, then that would make me consider selling out of them. That's truly going to be on a case-by-case basis though, and as I highlighted earlier, all of my BDC's credit qualities are still doing really well right now. Now, when it comes to what I would buy, down markets are always the best opportunity. When stock and fund prices fall, you have the chance to get more dividends for every dollar you invest. If a stock or an ETF normally yields around 6%, but because of a recession it falls in share price and it now yields 8 or 9%, then that's a great opportunity. More dividend income can be made and retirement can come sooner for people who have money to invest during a down market. I would still buy all the same asset classes in a downturn, like BDCs, covered call funds, closed-end funds, and these sorts. But whenever the markets do take a downturn, I usually prioritize the lower yielding positions that offer good growth and would now be offering a higher yield than normal. If something is normally boring, then a higher yield will always make it more interesting. I would buy heavily into a diversified dividend growth ETF like SCHD and my International Dividend Growth ETF, ticker IDVO. These two investments normally offer the lowest yields in my portfolio, but it's still really good to diversify into them because they provide excellent growth. REITs would also become much more appealing, especially to high-income investors, as their dividend yields would go way above normal. These would be the investment types that I would prioritize if the markets did take a nosedive. Odds are good that I would likely pick up other positions if they present good buying opportunities, but that's going to be on a case-by-case basis. At this point, I want to make a couple of closing remarks. If you're an income investor, and regardless if you're retired, close to retiring, or not even close to retiring, the majority of your income holdings should always be in steady positions. Keep speculative investments as a small percentage of your overall portfolio. And if you do these two things, then you'll always be ready for whenever a recession comes. You won't have to do too much scrambling when one starts, or guessing when the next one is coming, or when it'll be over. It's best to always be prepared at all times. As a seasoned income investor myself, another big piece of advice I would give is learn to not worry about the share prices of your holdings when the market falls. If you invest for high income, then focus most on your income and the safety of your dividends. If you pick good investments, then the share prices of whatever you're invested in will eventually recover. Focus on quality and not necessarily what's offering the highest yield in whatever sector you're looking at, and you'll be much better off. And with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.